Welcome to our channel, where we keep you updated with the latest trends and insights in the world of technology investing. Today, we are going to talk about a financial instrument that has been gaining a lot of attention in the investment world: exchange-traded funds, or ETFs for short. You might be asking, what exactly are ETFs? In the simplest terms, ETFs are funds that track indexes like the NASDAQ 100 Index, S&P 500, Dow Jones, and so on. When you buy shares of an ETF, you are buying shares of a portfolio that tracks the yield and return of its native index. The main difference between ETFs and other types of index funds is that ETFs don't try to outperform their corresponding index, they simply mirror its performance. They combine the range of a diversified portfolio with the simplicity of trading a single stock. So why are ETFs important for investors? Well, they offer an effective way to diversify your portfolio across a broad spectrum of industries, including the rapidly evolving technology sector, without the need to buy each individual stock. This makes them a great tool for reducing risk while still participating in the potential growth of a sector. And that brings us to the topic of our video today: 4 top technology ETFs. These ETFs have shown considerable performance in the tech sector, reflecting the growth and innovation in this field. They offer an exciting opportunity for investors to gain exposure to some of the leading technology companies without having to pick individual stocks. These top technology ETFs we'll be discussing are Vanguard Information Technology, ETF, VGT, iShares US Technology ETF, IYW, Fidelity MSCI Information Technology Index ETF, FTEC, and ProShares Ultra Technology, ROM. Each of these ETFs offers a unique blend of holdings, performance, and potential for growth. Join us as we delve into the specifics of these top technology ETFs: VGT, IYW, FTEC, and ROM. We'll explore what makes them tick, their holdings, and how they have performed over the years. So whether you're an experienced investor or just starting out, this information could be a valuable addition to your investing toolkit. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First on our list is the Vanguard Information Technology ETF, also known as VGT. Now let's delve deeper into what VGT is. In essence, the Vanguard Information Technology ETF, VGT, is a fund that tracks the performance of the MSCI US Investable Market Information Technology Index. This index includes stocks of companies in the United States that are engaged in the business of providing information technology-related products and services. These companies could be involved in software development, cloud services, hardware production, and a host of other tech-related fields. VGT is a standout performer thanks to its broad exposure to the technology sector. As of now, VGT has over 300 holdings. These holdings mostly consist of large-cap US companies such as Apple, Microsoft, and Nvidia, which dominate the tech industry. These tech giants have consistently shown strong growth potential and have played a significant role in VGT's performance. And speaking of performance, VGT has been nothing short of impressive. Over the past decade, the fund has outperformed the broader market with an average annual return of around 20%. In 2023, VGT delivered a return of about 32%, outpacing the S&P 500, which had a return of around 29%. Now, what makes VGT a top technology ETF? Several factors contribute to its high standing. Firstly, it's the fund's large exposure to the technology sector. VGT is known for its significant investment in tech giants that have not only proven to be market leaders but also shown consistent growth over time. By investing in VGT, investors gain access to these high-performing tech companies, which might be difficult to achieve individually. Secondly, VGT's low expense ratio is another attractive feature. At just 10 basis points or 0.1%, it's one of the lowest you will find in the ETF market. This low cost means more of your investment goes towards your potential returns rather than being eaten up by fees. Lastly, VGT's liquidity is another strong point. With high daily trading volumes, investors can easily buy or sell shares of the ETF. This liquidity makes VGT a flexible investment option, allowing investors to adjust their positions as needed. But as with any investment, there are risks involved. The fund's heavy reliance on a few large-cap tech stocks means that if these companies perform poorly, the overall performance of VGT could be negatively impacted. Moreover, as a sector-specific ETF, VGT is more vulnerable to industry-specific risks than a more diversified fund. However, despite these risks, VGT's strong performance and the potential of the technology sector make it an attractive investment. The tech industry continues to be a major driver of economic growth and innovation, and VGT provides an opportunity to capitalize on this trend. In conclusion, VGT is an ETF that offers broad exposure to the technology sector with a focus on large-cap U.S. tech companies. It has a strong performance history, a low expense ratio, and high liquidity. These factors, coupled with the continued growth and innovation in the tech industry, make VGT a compelling choice for tech-focused investors. Given its exposure to some of the biggest tech giants, VGT is a compelling choice for tech-focused investors. Next up, we have the iShares U.S. Technology ETF, or IYW for short. Dipping our toes into the world of exchange-traded funds, IYW is more than just an acronym. It stands for the iShares U.S. Technology ETF, a fund that offers a unique and concentrated approach to investing in the technology sector. It's a fund that's caught the eye of many an investor, and for good reason. You see, IYW is all about giving investors access to the U.S. technology sector. It's designed to track the performance of the Dow Jones U.S. Technology Capped Index, a benchmark index that includes U.S. tech companies with a strong market presence. This fund doesn't just dabble in the tech sector, it dives in headfirst, providing exposure to some of the biggest movers and shakers in the industry. Now let's talk performance. Since its inception in the year 2000, IYW has shown a consistent upward trajectory. It has delivered impressive returns, particularly in the past decade, a period that's seen unprecedented growth in the tech sector. Of course, past performance isn't a guarantee of future results, but the track record of IYW speaks volumes about its potential. One of the key factors that make IYW a top technology ETF is its portfolio. The fund is heavily weighted towards the largest tech companies, the ones that are shaping our digital world. Think Apple, Microsoft, and Alphabet, the parent company of Google. These giants of the tech world make up a significant portion of IYW's portfolio, giving investors a chance to ride on their success. But it's not just about the big players. IYW also includes a mix of smaller, high-growth companies. This blend of established giants and rising stars provides a balanced exposure to the tech sector, making IYW a compelling option for investors looking for growth potential and sector diversification. Another aspect that sets IYW apart is its low expense ratio. At 0.42%, it's lower than the average for sector ETFs. This means that more of your investment goes towards buying assets rather than paying fees. And in the world of investing, every little bit counts. It's also worth noting that IYW is a liquid fund, meaning it's easy to buy and sell shares. This liquidity makes it a flexible option for investors, allowing them to adjust their holdings as per their investment strategy and market conditions. A word of caution though. Like any investment, IYW comes with its share of risks. The fund's concentrated approach means it's heavily dependent on the performance of the tech sector. If the sector takes a hit, so could the value of your investment. It's always important to consider these risks and make informed decisions. So, there you have it. The iShares U.S. Technology ETF, or IYW, offers a unique way to invest in the tech sector. It provides exposure to some of the biggest names in the industry and offers a balanced portfolio that blends established giants with high-growth companies. Its consistent performance, low expense ratio, and high liquidity make it a compelling option for tech-focused investors. With its focus on top-tier tech companies, IYW offers a concentrated approach to tech investing. Third on our list is the Fidelity MSCI Information Technology Index ETF, known as FTC. Now let's delve into the specifics of FTC. This exchange-traded fund is sponsored by Fidelity, one of the most reputable names in the investment world. FTEC aims to track the MSCI USA IMI Information Technology Index, a benchmark that represents the performance of the information technology sector in the U.S. equity market. So what's so special about FTEC? For starters, it's a cost-effective way to gain exposure to the tech sector. With an expense ratio of just 0.08%, it's one of the most affordable tech ETFs out there. This low cost, coupled with Fidelity's strong reputation, makes FTC an attractive option for investors looking to venture into the tech space. Let's talk performance. Over the past 5 years, FTC has consistently outperformed the broader market. In 2021, for instance, it delivered a whopping 30% return, significantly outpacing the S&P 500. This trend of strong performance has continued into the current year, with FTC posting double-digit returns thus far. FTC's robust performance is largely due to its holdings. The ETF is heavily weighted toward the largest tech companies in the US, including giants like Apple, Microsoft, and Nvidia. These companies have a proven track record of innovation and strong earnings growth, which has helped propel FTC's performance. But it's not just about the big names. FTC also offers exposure to a diverse range of tech subsectors, from software and services to technology, hardware, and semiconductors. This broad exposure allows investors to benefit from the growth potential of the entire tech sector, not just a few select companies. Now, no investment is without risk, and FTC is no exception. The tech sector is notoriously volatile, and FTC's performance can fluctuate wildly in response to market conditions. However, FTC's diversification helps mitigate this risk. By spreading its investments across a wide range of tech companies, FTC is less susceptible to the performance of any single stock. So why consider FTC as a top technology ETF? First, it offers broad exposure to the tech sector, allowing investors to tap into the growth potential of this rapidly evolving industry. Second, it's backed by Fidelity, a trusted name in the investment world. Third, it has a track record of strong performance, consistently outpacing the broader market. And finally, it's a cost-effective way to gain exposure to the tech sector with one of the lowest expense ratios among tech ETFs. Of course, it's important to remember that past performance is not indicative of future results. Investing in ETFs, like any investment, involves risk, and it's crucial to do your homework before diving in. That said, for investors with a high risk tolerance and a long-term horizon, FTEC can be an attractive option. In conclusion, FTC brings together the innovation and dynamism of the tech sector with the reliability and cost-effectiveness of an ETF. It offers a compelling blend of performance, diversification, and affordability, making it a worthy contender for any tech-focused investment portfolio. FTEC's broad exposure to the tech sector makes it a valuable addition to any tech-savvy investor's portfolio. Last but certainly not least, we have the ProShares Ultra Technology, or RAM. Now, what makes RAM stand out in the crowded field of technology ETFs? Let's dive in and find out. RAM is a leveraged ETF, which means it aims to deliver twice the daily performance of its benchmark index, the Dow Jones U.S. Technology Index. The focus is on large-cap technology stocks, including some of the biggest names in the industry. But remember, while the potential for high returns is enticing, this also comes with a higher level of risk due to its leveraged nature. Now, let's talk about performance. Over the past 5 years, RAM has enjoyed a stellar run, significantly outperforming the broader market. Its annualized returns have consistently been in the double digits, demonstrating its potential for robust growth. But remember, past performance is not a guarantee for future results. What's interesting about RAM is its sector allocation. It is heavily weighted towards software and services, followed by technology, hardware, and semiconductors. This means that RAM offers exposure to some of the fastest-growing segments of the tech industry, from cloud computing to artificial intelligence. Another notable aspect of RAM is its concentration. The top 10 holdings account for a significant portion of the fund's total assets. These include industry titans like Apple, Microsoft, and Alphabet, which have been driving innovation and growth in the tech sector. So by investing in RAM, you're essentially getting a piece of these tech powerhouses. But what about fees? Well, RAM is not the cheapest option out there. It charges an expense ratio slightly higher than the average for technology ETFs. But considering its performance and exposure, some may find this trade-off worthwhile. Now you might be wondering, why is RAM considered a top technology ETF? Well, there are a few reasons. First, its leverage strategy offers the potential for high returns in a booming tech sector. Second, it provides exposure to some of the most innovative companies in the world. And third, despite its higher expense ratio, its strong performance has more than made up for it. However, it's essential to note that RAM is not for everyone. Its leveraged nature makes it more volatile and riskier than traditional ETFs. Therefore, it's best suited for investors who have a high risk tolerance and can withstand potential losses. Additionally, due to its daily reset feature, it's more appropriate for short-term trading rather than long-term investing. In conclusion, ROM is a unique player in the technology ETF field. It offers an aggressive strategy for those willing to take on more risk in exchange for potentially higher returns. It provides exposure to some of the most influential tech companies contributing to the digital revolution. It has demonstrated strong performance, although it comes with a higher expense ratio. Like all investments, it's crucial to do your own research and consider your financial goals and risk tolerance before investing in ROM. And as always, diversification across various sectors and asset classes is key to a well-balanced portfolio. For those willing to take on more risk for potentially higher returns, ROM could be an intriguing choice. There you have it, a comprehensive look at 4 of the top technology ETFs in the market. We've delved into the nuances, the unique attributes, and the potential of each one, giving you a well-rounded understanding of VGT, IYW, FTEC, and ROM. Remember, VGT is a highly popular ETF, known for its focus on information technology. It's a favorite among investors for its broad exposure to the tech sector. Then we have IYDW, which offers an impressive portfolio of tech and telecom companies. It's a fantastic option for those wanting to diversify within the tech industry. Next, we explored FTC, an ETF that stands out for its low expense ratio and its strong historical performance. It's a solid choice for investors looking to capitalize on the growth of the technology sector. And lastly, we discussed ROM, a leveraged ETF that offers the opportunity for significant returns, but accompanied by a higher level of risk. Each of these ETFs has its own strengths and potential drawbacks. Investing in any of these requires a clear understanding of your own risk tolerance, investment goals, and the specific characteristics of the ETF. Let's not forget, the world of investing is as complex as it is rewarding. It's crucial to do your own research, consult with a financial advisor if needed, and make informed decisions that align with your financial objectives. These 4 ETFs are just the tip of the iceberg in the vast ocean of investment opportunities out there. Keep learning, keep exploring, and keep striving to make your money work for you. If you found this video helpful, please give us a thumbs up, share it with your friends, and don't forget to hit the subscribe button to stay updated on our latest content. Until next time, happy investing.